Welcome back. Now a look at where markets ended a holiday-shortened week following PCE and GDP numbers. All indices ending the month of November with gains as investors weigh what a Trump 2.0 means for the economy heading into 2025. All of this as Trump is rounding out his economic team, tapping trade lawyer Jamieson Greer as the next U.S. trade representative, nominating longtime advisor Kevin Hassett to lead the National Economic Council. Joining me now with a look at the team and what's ahead is the Lonski Group president, John Lonski. John, great to see you. Thank you so much for being here. So we've got a pretty good rally underway year to date. We've got optimism going into the new year. How would you assess the Trump team and the macro story, the backdrop to all of this right now?
Well, the Trump team is a big improvement over the Biden team. And as a result, consumers and businesses are more optimistic going into 2025. The only problem might be is that the economy grows so rapidly over the next several months that it brings about a revival of inflation fears. But I'm crossing my fingers right now that that won't happen, in part perhaps because we are going to see an increase in the production of crude oil, fossil fuels, and that will help to rein in possible price increases elsewhere.
Yeah, and that certainly was what President Trump has been talking about. If he taps into the energy capacity of America, he takes oil prices down and perhaps impacts inflation overall. But President Trump is threatening to hit our largest trading partners with new tariffs on day one, his first day in office. Goldman Sachs is estimating that the tariff increases would boost inflation nearly 1%, as a recent Harris poll shows that 2/3 of Americans are worried that tariffs could hit them right in their wallets, causing higher prices on everyday goods. How are you seeing the tariff situation right now, John?
Okay, I'm not as pessimistic as Goldman Sachs. I could see tariffs increasing price inflation by between 0.5 percentage point and 0.75 percentage point. Still, that implies that prices will be higher than otherwise because of tariffs. You know, one thing I want to add is that the markets don't appear to be especially worried about tariffs. My goodness, we have the 10-year Treasury yield that has actually been declining. At last look, it was down to about 4.25%. That happens to mean that mortgage yields will be a little bit lower. And moreover, the implied probability of a Fed rate cut on December 18th has risen from 55% up to 66%. So what the markets are telling me is that the imposition of tariffs will not be a disaster for the U.S. economy. And let's not forget why Trump is increasing these tariffs. That is to help bring about a halt to illegal immigration as well as stop this horrendous inflow of fentanyl.
Yeah, it's all great points. I agree with you. I think these worries over tariffs are probably a lot of nothing, given that President Trump has talked a lot about using it as leverage to help him elsewhere. In fact, even this most recent tariff conversation was because of the southern border. He's saying, look, help us with the illegal migrants coming in, the fentanyl coming in, or yes, you will pay.
I see, why not go ahead and use tariffs as a policy tool? Why not use it as a negotiating chip? There's no reason that we should not employ this. After all, there is no consumer spending market in the world as large as that of the United States. So it heeds these exporters to do things that will help improve the quality of life in the United States.
John, let me get your take on the markets and investing in 2025. We're going into the new year with major gains in tech stocks. NVIDIA is now a Dow component. It has led the NASDAQ and the Dow. NASDAQ up 25+% for this year. Do you think this has legs into 2025? How would you allocate capital in the new year? Big tech or broaden it out?
I would broaden it out. I would look to diversify, and I would look at perhaps some financially strong companies that are providing you with dividend yields in excess of 3%. Those are attractive candidates. And of course, some are wandering into smaller company stocks. We find that the Russell 2000 has outrun the overall market since Election Day. Perhaps we'll see more of that. But again, again, tech is so richly valued that there is indeed more of a downside risk because of high valuations, more room for disappointment. And of course, when you have very high price to earnings ratios, those stocks tend to be more susceptible to any surprise increase by interest rates.
Yeah, and a lot of this has to do with optimism over the incoming policies. Investors are counting on deregulation. They're counting on the extension of the Trump tax cuts. But they're also looking ahead to potentially new areas of investment like crypto. President Trump has said that he wants potentially a White House role that will oversee crypto and digital assets. I know that the Congress is also working on what they're calling a revolution to come in digital assets. John, what do you make of this move in Bitcoin? And would you allocate money to digital assets today? How is that going to play out?
Well, I'll tell you, this is one of the surprising stories. The latter part of this year, we have Bitcoin approaching $100,000. That was unthinkable about a year ago. You know, you have to recognize that Bitcoin is really not a type of currency yet because it's so volatile in terms of price. Bitcoin remains a speculative asset. If you want to go ahead and have some exposure to Bitcoin, go ahead and do so, but don't bet the house on it. That is, keep a relatively small percentage of your portfolio in Bitcoin and no more.
Okay. And what about the Fed, John? In December, we'll see the next Fed meeting. There is a good chance that we see another rate cut, although the most recent commentary from Jay Powell was that they're not in any rush. So what should we expect from the Federal Reserve and potential rate cuts to come?
Okay. I'm going to go along with market sentiment. That is, we do get a rate cut in December. Fed funds goes down to 4.38%. But we may not have a rate cut during the first quarter of next year as the Fed takes a more cautious wait-and-see stance. The Fed wants to see whether or not the labor market does not overheat, once again puts upward pressure on wages, and that in turn would force prices higher. So, yeah, you'll see one more rate cut, at least for the time being. But if it turns out that Trump's economic program sets off an economic boom in 2025, 4.38% could be the bottom for this current series of Fed rate cuts.
Yeah, it's a great point, because why would the Fed be cutting when, in fact, the economy is booming? We'll see. We'll see if that's a good problem to have. John, it's great to see you. Thank you so much. Have a great rest of your Thanksgiving weekend.
Thank you, Maria. Happy Thanksgiving.
And to you, John Lonski.